Make money no matter which way the market moves. Hedging sounds like a strategy that is too good to be true, and although there is risk when using this strategy, if used correctly, you can make a lot of money. Now, before I get into this video, I do just want to say that I am not a financial advisor, and I recommend you do your own research before entering any trades. Now, hedging is popularly used alongside other strategies in order to increase the chance of profitability, which is obviously always the goal when trading. And the idea of hedging is to maximize profits no matter which way the market moves. So if the market moves upwards, but you have a short, it is still possible for you to make money. Now, it is also trying to decrease the chance of you losing money to the smallest amount possible, although the one catch is when you do end up losing money, you can lose a little bit more money than you normally would, maybe using a stop loss or any other type of strategy, although I will explain that fully in this video. First off, let's get into the basics and talk about how hedging works. Hedging is comprised of two parts: the initial trade and the backup position. So pretty much what you're doing is you are putting one trade, which is the initial trade you're putting out on the market. So let me give you an example here. For example, if I wanted to short right here and open a position at the current price, that would be my initial trade. That is the trade I'm starting with. That is the trade that I'm opening where I think the market is going to go. And now we're going to have to focus on how do I reduce the risk in case the market ends up going in the opposite direction. What if it goes up instead of going down, which is the way that I would make money? So what you are going to want to do is first off determine a target and stop loss point for this trade. So for example, if my short is here, then maybe I want to have a take profit right here. I think that once it gets to this level, just as an example, I want to exit the trade because I think that's the most profit I will be getting out of this trade. And then I want to have a point for stop loss. So I think if the trade goes past this position, then I think for sure it is going to be going up. Now you might be saying, well, this looks exactly like all the trades I'm currently making, but this is where hedging comes in. Now we are going to be putting a second order on the order book, meaning we're going to have an order that is not immediately filled. So just an example, since I am currently in a short and my stop loss is right here, I'm going to put a long order right above the stop loss. Now in reality, in this example, there is more of a gap between these two orders, but whenever you are actually doing this on a real trade, you want to make sure to probably keep these as close as possible, because ideally, once the trade breaks the stop loss, so if you have this short open, for example, if it ends up going up and hitting your stop loss, you want to be into that long position as fast as possible, because basically what you're saying is, if it doesn't go in my direction, if this short doesn't go downwards, then I know for sure that we're going to have a fast move upwards. So I want to get out of this position as fast as possible once I'm in that zone where I think this trade is no longer valid. And then I want to be in a long position in order to profit from it moving upwards. Now that you have your long order set on the order book, you now want to have a target and stop loss for this trade as well. Now, I'm going to talk about where you want to put these orders, as this is also very important. So if you have your long entry right here at this point, then let's say I have my target right up here. You want to keep the targets for both of your trades to be about the same. Although obviously if you are more confident in one side, then you can always adjust it to your needs. Now, once you have your target set, you want to set the stop loss of this trade right above the entry of your current order is. So for example, right here, I have my initial short right here in this zone, and I am hoping that the trade is going to go downwards. Now, if it goes downwards, then I will be making that nice profit from my short, and this is the move that I expect to happen. However, if it does go in the opposite direction, then what will happen is it will go up, it will hit my stop loss at this level, and then it will enter a long. And then once the long is open and the short is no longer there since it was closed right here at this level, now I'm going to have this long with a stop loss right here, right above where my short was, and a take profit right up here in order to try to make back the money that I lost from this initial position hitting the stop loss. So let me talk about the possibilities that can happen from this position. So the first possibility is probably the best case scenario. You have the order go in the direction that you want it to go. So you're opening with a short and it never hits a stop loss. It just goes directly downwards, hits your take profit, and then you get a profit of 9.4 pips. That is the ideal situation. The second scenario that can happen is, say it does not go in your direction. So say maybe it goes down a little bit, it doesn't hit your take profit, and then it starts going back up and it gets to the point where it hits your stop loss on your short. So your stop loss on the short is hit and you are going to be losing 3.7 pips. But wait, now that you lost 3.7 pips, you are going to open the long position. And since you are betting at this zone, that since it didn't go down, I know for a fact it's going to go up. Now, if it continues to go up and goes to your take profit on the long, then you are going to be making 7.4 pips. And as you can see here, you are still going to be making money. You are going to be making around 2.5 pips of profit. So you are still making profit even if it doesn't go in the direction that you were hoping it to go to. So those are the two best case scenario situations. Now, let me talk about the worst case scenario. This is where you're going to be losing money, although once again, you have to think about the risk reward, because at the end of the day, this is really just a money management strategy. So let's say that the price goes down and you're getting excited, but then it starts to bounce up and you enter your long right here. So the short gets closed and the long gets opened. But then it goes right back down and it hits your stop loss once again. So you lose both positions. You're hitting both stop losses. Then what's going to happen is up here, you are going to be losing 3.7 pips. And then on the long, once it hits the stop loss, you are going to be losing 4 pips of profit. So you are going to be losing in total 7 pips of profit. So that is the worst case scenario if it doesn't go the way that you were hoping, but then it also still bounces back and forth in between the zones that you were hoping it would rocket out of. So that's where we get to the point of thinking about what strategies you can use with hedging. Obviously, hedging is super useful if you know you're at a zone that is going to be extremely important. If you think that there is a 100% chance that we are going to break out of this zone, so maybe that can be from an important point on the chart, you think this is a very important support or resistance, and you think, okay, no matter what, it's either going to reject this resistance and then fall down, or it's going to break the resistance and shoot all the way up, then this can be a very good situation to use hedging. And another situation you can use this in is, say, for example, you know that there's going to be very, very big news in the market. Obviously, if there's something big in the market, then the market's either going to spike up really fast in one candle or spike all the way down. And if you do hedge whenever there's big news or something like that, then you will always make profit. So those are two really good situations that you can use hedging in. And obviously you can develop strategies around hedging in order to become profitable and increase your chances of profitability as high as possible. Anyways, guys, thank you guys so much for watching this video. Hopefully you now understand what hedging is. I know it's a super hyped strategy. A lot of experienced investors use it. And hopefully now you understand why. Thank you guys so much for watching this video, and see you guys in the next one.